We just closed on our mortgage refinancing a few days ago. 2.55%. That's what we locked in on our 30-year fixed rate mortgage around Thanksgiving time. Our rate, if we applied today, Valentine's Day morning, when I'm taping this video, it looked more like this 4+% here. That, my financial friend, was my inflation slap in the face moment. You know, the one where you're like, oh my goodness, prices have gone up. Many of you already know that I've been working on some inflation stuff for you, but that inflation slap in the face moment was when I knew we had to get this video out to you guys as soon as possible. This video in particular is for you if you're worried about inflation and your debt. Not the government's debt that they've been piling on like a kid getting free candy, but your mortgage, your private student loans, and your credit cards. By the end of this video, you'll know what you should do with your debt right now, as well as my thoughts on inflation and interest rates. Is 4% the end? Or is it 10%? Or even more? Watch on and find out. Keep in mind, I don't have a crystal ball. I wish I did. But Marcus, my husband, and we've been around the financial block more than a few times. Seen our share of up, down, and very down markets. And we had a bad feeling for most of last year. A bad feeling that inflation would skyrocket, that interest rates would go up to bring inflation back under control, and that we'd be stuck paying those higher interest rates when we had to refinance our mortgage a few years down the line. And that's how we got this 2.55%. A bit of intuition, fear, and luck all together. That's right, we think inflation is going to be here for a while, and that we haven't seen the worst pain yet. How long it will last, I don't know. According to Investopedia, since 1950, the average economic cycle in the US has lasted roughly 5.5 years. But again, no one has a crystal ball. Our expectation is that inflation won't just magically disappear, poof, overnight, because it didn't just magically appear overnight. The writing's been on the wall for a long time coming. You simply cannot keep printing money and handing out free stimulus checks, no strings attached, and not expect to see any repercussions. Well, it turns out those free stimulus checks weren't free after all, and inflation is the price we're all paying now. Get it? Inflation is the price we're paying? Anyway, geek joke. Now, I don't think we'll see hyperinflation like in Argentina or Turkey, and we shouldn't, as we're in a different economic league. No disrespect intended, but facts are facts. What we will see, though, are painful price increases in our groceries, our gasoline, our healthcare, and our everyday life. And despite what Krugman and his followers say, inflation is dangerous. It's dangerous for you, for me, and especially for those of you that are closer to or in retirement. Because unless your salary and earnings, which most of us will have significantly less of in retirement, unless those increase at the same 7.5% inflation number that was released in early February, you and we simply have less money for everything. We are poorer. So inflation is here, and it's at a 39-year peak. The last time it was even close to this level was in 1982. Many of you watching this weren't even born yet. This means that the Federal Reserve Bank, the Fed for short, will need to raise interest rates to bring inflation back down under control. As Jerome Powell, the chairman of the Fed, the great money printers of the United States of America, stated in a January briefing, I think there's quite a bit of room to raise interest rates without threatening the labor market. And while that first rate hike hasn't even happened yet, it's already being priced into things like this current 4+% 30-year fixed rate mortgage. So how high might interest rates go? Major banks like Goldman Sachs and Bank of America are projecting about 7 rate hikes this year, of roughly 25 basis points or 0.25% each time, starting in March. So in total, that's a rate increase of at least 1.75% for just 2022 alone. If only that were enough. Now, economics was a long time ago, but it was one of my favorite classes. This is the 7.5% year-over-year inflation number that was recently released. This is the current interest rate on a 30-year fixed rate mortgage. The simplest, easy way to think about this is, how long will banks keep lending out money to folks like you and me at this rate when that money is costing them this much? The answer is not very long. As I said earlier, I can't predict the future, but simple economics indicates that to battle against a 7.5% inflation rate, interest rates will need to go up much higher than this unrealistically optimistic projection of 7 timid mini hikes up to 1.75%. 8%, 9%, 10%, who knows? What I can tell you though, at this point, is how to best deal with inflation and your debt. Let's start with mortgages and private student loans first. So generally speaking, there are 4 scenarios when it comes to mortgages and private student loans. I've grouped mortgages and private student loans together because for the most part, you would handle both types of debt in a similar manner. Scenario 1, you have a fixed rate loan that you cannot pay back in full when it comes due. Let's say you have a mortgage outstanding of $200,000 and it's due in 2023. You'll pay it down a bit, but you'll still need to extend it to refinance it in the middle of next year. In this case, the best thing to do would be to refinance it now into another fixed rate loan. Because even though this current 4+% interest rate on a 30-year mortgage is higher than it was months ago, it's still low, relatively speaking. And if you wait to refinance, the most likely direction it will go is up, given the current astronomical inflation rates. It's what's known in the industry as refinancing risk. Refinancing now means you get rid of this refinancing risk. You extend the maturity of your remaining mortgage balance for another 10, 20, or 30 years, and you will sleep well at night, knowing that your monthly payments will remain fixed for that period. When you refinance your loan, make sure there are no prepayment penalties. So if you do end up with extra cash a few years down the line, say if you get a new job or a salary increase, you have the option of using that extra money towards paying back your debt. And with inflation making salary increases more likely, fingers crossed, this may even help you pay down your mortgage a bit faster. Scenario 2. You have a fixed rate loan that you can pay back when it comes due. In this case, and assuming that you already have an interest rate that you're happy with, no better offers out there, then you would just do nothing. Pay what you're supposed to pay the bank every month. Don't throw extra money on top of your loan and try to pay it off earlier though. Instead, see what other better opportunities you might have for your extra money to work for you, like putting that money into a tax-deferred 401k, IRA, or HSA. I'll talk more about this in one of my next inflation videos, so if you're interested, don't forget to... Scenario 3. You have a variable rate loan that you cannot pay back when it comes due. Think an adjustable rate mortgage, an ARM, or a private student loan on a variable rate. Even if your variable interest rate right now might be lower than what a new fixed rate loan might cost you, that variable rate will go up as it will follow inflation. The higher inflation will be, the higher your interest rate and your monthly payment will also be. What happens when it does go up to 8, 9, or 10+%? Those monthly payments will kill you, or what I call, for obvious reasons, the monthly payments will kill you risk. It's very high. And by the way, I don't think there's a better industry term for the monthly payments will kill you risk, but if you do know of one, drop it in the comments below. When that variable rate goes up, and it will, this current 4% plus rate on a 30-year mortgage will look like a bargain. As always, make sure there are no prepayment penalties in case you're able to pay your loan back early. And that's why we refinanced our ARM, our adjustable or variable rate mortgage, into a fixed rate loan. Firstly, it fixes our monthly payments for 30 years so that we can have peace of mind knowing that we eliminated the monthly payments will kill you risk. And secondly, we also took care of our refinancing risk early. Our current adjustable rate mortgage would have expired at exactly the same time as when our 4 kids would be in their peak college tuition years. Yes, all 4 at the same time. And who knows what that's gonna look like? Actually, I do know what it's gonna look like, and it's gonna look bad. So we ended up going with First Republic Bank after a lot of shopping around. Best rate, as you've seen, and great service. Now, rates have gone up recently, but it's still worth taking a look at First Republic. I've included the link to our First Republic banker below. Reach out, say you watched my YouTube video, and see what he might be able to do for you. Scenario 4. You have a variable rate loan that you can repay when it comes due. In this case, if your loan ends within the next 18 months, just pay as much of it back as quickly as possible. If you only have 18 months left on the loan, it's mostly principal that you're paying down anyway. The interest is minimal. So even if the interest rates keep going up, it's really not costing you so much. And think of the time, the effort, and the possible refinancing costs involved. I've refinanced more times than I can count on both my hands and feet, personally and professionally. And in my experience, for the majority of cases, the refinancing effort is not worth it for a remaining time of under 18 months. You'll be better off with just trying to pay off your loan as fast as possible. Do note that for student loans, there aren't any refinancing costs in most cases. But for mortgages, the refinancing costs can be huge, and your time and effort will be required in both cases. Now, if you have a variable rate loan that you can repay when it comes due, but that due date is more than 18 months out, then refinance into a fixed rate loan for the same reason as in scenario 3. Because rates on fixed rate loans are still relatively low now. And you'll get rid of the monthly payments will kill you risk. As I always say though, everyone's financial journey is different. Your situation may have special nuances, and if this is the case, or if you simply want an extra eye to check in on how to best inflation-proof your finances before interest rates get even higher, then drop me a note at jennifer@diamondnestegg.com. And if you found this helpful, don't forget to give that thumbs up and subscribe, a gentle tap. It'll help get this video out to others who are trying to sort out their debt and fight against the ugly inflation beast. For those of you with federal student loans, not the private ones I've been talking about so far, there are special considerations. Take a look at this video here to learn more about what these special considerations are, because what's appropriate for private student loans in our current inflationary environment may not be appropriate for you. If you have credit card debt outstanding, pay off whatever you can as fast as you can. Credit cards are based on variable interest rates, meaning you'll be paying more interest on your credit card balances as interest rates go up this year to curb inflation. According to USA Today, Fed rate hikes tend to be passed along to credit card holders within a month or two, which means if the first rate hike is expected in March, the interest rate on your credit cards might go up as soon as April or May. Credit card interest rates are already very close to their all-time pre-pandemic high of 17%. Who knows how much further up they can go? So pay off those credit card balances sooner rather than later, and don't rack up any more credit card debt. If you're really unable to pay off your credit card balances, then the next best thing to do is to consolidate your higher interest credit card debt into a lower interest fixed rate personal loan so that you can still grab the current low interest rates before the Fed pushes rates up to even higher levels. You can learn more about credit card consolidation here. SoFi and Payoff are the two lenders we use most often for this. Inflation and higher interest rates are here to stay with us for a while. How bad it will really get and for how long remains to be seen. Now's not the time to sit still though. What you need to do now is to figure out how to best protect your wealth in this new world of rising prices and rising interest rates. Shoot us an email if you have any questions or need additional one-on-one guidance. I hope you enjoyed this video. If you did, Don't forget that thumbs up and subscribe. I'll see you next week with another money-saving, wealth-building video for you, my financial friend. We may have to talk more about this ugly inflation beast again.